Welcome to episode 22 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, BTR, and a lot of news this week in these last 7 or so days touching on rental housing. We're going to cover a lot of headlines today. Also, we had more REITs reporting their earnings, so we'll touch on a few highlights there. Of course, we went into that in more depth in last week's podcast, at least for the top six. The big six apartment REITs. We'll have a few notes on some of the smaller apartment REITs, and then still to report are the single family rental REITs, which we'll cover in future episodes. And then the main event today will be a conversation with the founder and CEO of Citymark Capital, Dan Walsh. We'll be talking about the institutional shift from equity to debt. And maybe shift is too strong of a word. Obviously, institutions are still in the equity game, but some of them are increasingly seeing debt funds as an attractive play. KKR just announced a new debt fund, and Dan was in on this early, leveraging his background in banking before he had made the jump into apartment ownership. And he really has a great story we're going to dive into. So you've probably seen Dan in different events on stage. He was at NMHC. He and I did a panel together at the annual meeting. But if you don't know his story, it's a really interesting one. And we'll talk about how Citymark sold a lot of their portfolio during the peak, really at the right time, and how they've been retooling with a focus on buying loans from banks and debt funds. So that'll be a fun conversation. Before we jump in, I want to give a big shout out to our sponsors. First and foremost, to Madera Residential. Check them out at maderaresidential.com. And secondarily, to JPI. Check them out, jpi.com, one of the top apartment builders and developers in the nation. All right, so as always, kick it off with, here's a chart. And I want to share one I recently posted on LinkedIn. The title of this one is REITs Represent a Growing but Tiny Share of Apartment Construction. All right, so last week I covered 5 key themes from the recent REIT earnings calls from Avalon Bay, Camden, Equity Residential, Essex, MAA, and UDR. And one of those themes is around how REITs are ramping up construction again. But I also made the point that just because REITs are doing it, that doesn't mean every developer can. And also, of course, the REITs represent a tiny share of the market. And I made a comment that I thought the number would be in the single digits, but then I had to do the math. I wanted to go see what that share actually was in terms of the big six apartment REITs share of total starts. And sure enough, they really don't move the needle that much. So here's a crazy stat just for some context here. If you combine those big six apartment REITs, they collectively would not have ranked in the National Multifamily Housing Council's top 25 developers list, meaning that there were more than 25 individual developers who started more apartments in 2023, most recent rankings, than these big six apartment REITs did collectively combined. So that's how small they are relative to the rest of the market. They represented just 0.5% of apartment starts in 2023. Now, in 2024, they got a little more bullish. They ramped it up a little bit as the broader market continued to pull back. The big six REITs combined represent a whopping, are you ready for this, 2.6% of all apartment starts last year. And that marked the first time since 2015 where they represented at least 2% of all U.S. apartment starts. So their share will likely climb again in 2025, especially if REITs start as many projects as they have planned, particularly Avalon Bay and MAA, which have been most bullish on construction. But all of the REITs, with the maybe exception of EQR, do plan to start projects this year. And most apartment developers only wish they can do the same. Now, remember, I talked about this a little bit last time. Apartment construction is vastly different from single-family home building. Most apartments are built by merchant home builders raising equity from investors with the goal of paying them back plus some when they sell after leasing up the property. Now, REITs, as well as certain peers of theirs on the private side, they have a major advantage over most apartment builders. They have a lower cost of capital because they can typically self-fund the equity and they can borrow at comparatively attractive rates. And additionally, REITs and again some of their peers, they're build to hold players, so they're longer term, which allows them to be more flexible and patient than most merchant builders who dominate the construction landscape. So when you read about REITs ramping up construction, again, don't take that as a sign that the broader market is going to follow, at least not yet. This question came up with one of the REIT earning calls last week, and it's like, hey, are we going to see a big ramp up? And it's very unlikely that that occurs. Most developers would love to build more, but simply can't because the challenge is raising equity and finding projects that pencil out. All right, now moving along. We are still in REIT earnings call season. A few more of the REITs are reporting this week, and then more to follow in next week as well. This week we have IRT, Centerspace, Elm, and Clipper. And then one of the big SFR REITs, American Homes for Rent, is scheduled to release their earnings report today. The other SFR REIT, Invitation Homes, they don't report until February 26th. So we'll probably cover the REIT, the SFR REIT REITs in a couple of weeks in most likely the March 6th episode. A couple of things I'll share from the latest earnings reports. Number one, Independence Realty Trust, IRT, they had a busy Q4 on the acquisitions front. They announced closing of 2 deals in fourth quarter and a third going under contract. Those properties are in Charlotte, Orlando, and Indianapolis. And of course, Charlotte especially and Orlando secondarily have been attractive markets to most of the big REITs these days. Indianapolis is an interesting one, not a big REIT market today, but one that has become increasingly institutional, as I mentioned before in this podcast. And by the way, IRT and Centerspace are really the only 2 apartment REITs that have much of a Midwest presence at all. But that's, of course, been a very solid region. So a lot of the REITs say, hey, East Coast, Mid-Atlantic, still a strong spot. And maybe isolated parts of the West Coast. But some of that's because they just don't exist in the Midwest. And if they were, they would be up there as well. The Midwest would be up there as well. A second one to note, Elm Communities, which operates in the D.C. metro area, used to be known as Wash REIT because it was all Washington, D.C., but now also in the Atlanta metro area. They announced and had initiated a, quote, formal evaluation of strategic alternatives in an effort to maximize shareholder value. The board is working with independent financial and legal advisors to assess all options. All right, so Elm said they've executed their business plan to expand outside of DC, and they're confident in the long-term direction of their portfolio, and yet their shares continue to trade at a discount relative to their value or the net asset value in the private market. Elm also said they've retained Goldman Sachs and JLL as financial advisors. Now, they did caution, of course, that those moves don't necessarily mean there'll be a transaction of any type, but certainly potentially interesting move. So we'll have to see how that one plays out. Elm was one of the smaller apartment REITs, but still a big player in Washington, D.C., especially in kind of the Class B market, and increasingly becoming a player in the Atlanta metro area as well. All right, next up, rental housing trivia. All right, so while we're talking about REITs, we have another REIT trivia question for you today. And I'll be honest, this one's kind of a trick question. So here it is. At the end of 2010, there were 12 different apartment REITs with market caps greater than $1 billion. Which of the below was not one of them? Was it Archstone Smith, BRE Properties, Home Properties, or D, Post Properties? Now, give you a little hint. The giveaway is the year, 2010. All right, which was not a publicly traded REIT in 2010. Again, Archstone, BRE, Home, or Post. I'm going to give you that answer in a bit. Some of the old timers will probably know the answer to this one, and some of those are newer in the industry. I'm wondering who those brands even are or were. Next up in the news. All right, so we had a lot of headlines touched on rental housing this last week, and so I'm going to cover a few of them here. First one comes from Bloomberg. KKR raises more than $850 million for real estate credit fund. Let me reload it from the article written by Pat Clark. It says KKR raised more than $850 million for an opportunistic real estate fund, a credit fund, as investors see a ripening moment for financing property deals. It will be backed by first mortgages secured by high-quality properties in the U.S. and Europe. The firm is seeing potential for deals that offer an appealing measure of safety that may include lending to owners of multifamily or industrial buildings in markets where an influx of supply has made it harder to raise rents in the short term. All right. So certainly KKR is one of several groups expanding or creating debt funds targeting apartments, hoping to play into the need for debt or for refinancing, et cetera. We'll talk to Dan Walsh at Citymark more about how that works and why it can be more appealing than equity funds in some cases. And again, that'll be later on in the program today. Next headline comes from the Wall Street Journal. It says, "We are headed toward a landlord-friendly era. Expect higher rent prices. Prospect of rising apartment rents could further stoke inflation and give the Fed another reason to pause." All right. So let me read a little bit of this article here. It says, a spike in rents during the early years of the pandemic sparked a historic apartment construction boom in 23 and 24 that crushed new inventory, caused rents to fall in much of the country. Landlords say the new construction pipeline should be mostly drained by year-end, setting the stage for rents to rise nationwide later this year. And then a quote from Lee Everett, the head of research and strategy at Cortland. He said, the relationship is going to be very quickly, let me reread this. The relationship is going to very quickly flip from a renter-friendly environment to a landlord-friendly environment. So there we have it. My friend Lee giving the money quote to the Wall Street Journal. All right, so I've been writing about this and talking about this for the last, almost probably a couple of years now, as construction starts have been plunging. And of course, I wasn't the only one talking about it. The development cycles have been so volatile, and that's not been great for investors, developers, or renters. And it's a big reason why we've seen some of the rent volatility these past couple of years, or past, really handful of years. So, I think this really puts the Fed in a bit of a pickle. And I'm not sure this angle gets enough conversation right now. The article talks about a reason to pause. Well, it's a little more complicated than that. We think about shelter inflation. Inflation is still elevated, so interest rates are still elevated, and those higher rates are killing apartment and BTR construction starts, which we need more of to help further bring down inflation. And as we just saw, more construction helps taper inflation. So the Fed wants to see lower inflation before cutting rates. Builders and investors want to see lower rates before ramping up construction. And everyone, of course, agrees we need more housing to further tame inflation. Remember, housing, shelter is about a third of the consumer price index, and it's almost all of it's driven by rent. It's not home prices, it's rent. And, I won't get into the mechanics of it, but it is rent, okay? Now, ironically, the low interest rate environment of the COVID era and the post-COVID era contributed not only to inflation, but also contributed to the taming of inflation before the Fed started hiking rents. Now, we sometimes forget that latter part, but certainly cheap debt played a massive role in the 50-year high of construction that we saw for multifamily, and that in turn helped tame rent growth. Ironically, as it relates to rents and shelter, the Fed's rate hike since then did nothing to cool shelter inflation because it was already happening. Although certainly, obviously the hikes impacted other categories of CPI, to be fair, but rents, again, that's a third of the CPI's weighting. So here we are in 2025, multifamily starts have plunged to the lowest levels in 10 plus years. We're way past reverting to pre-COVID supply levels and instead trending toward post-GFC recovery supply levels of the early 2010s. And by that, I mean trending towards. So we still have a lot of completions, but by next year, we could see below average supply across the country, and that could put further upward pressure on rents. So if construction starts remain depressed and demand remains strong, we could see that rent reacceleration in 26 and 27, like this article is suggesting. And there's little chance the Fed can really change that trajectory at this point, even if they cut rates today, because it takes, of course, around 2 years to get projects planned and approved and built. And that's what, investors everywhere are pretty much banking on right now, with renewed rent growth in 26 and 27. So we're not there yet. Obviously, a lot can happen in the economy and whatnot, but, rents are still flat right now nationally. But certainly if demand continues like this, as supply tapers back, we're going to be marching in that direction. So again, tough spot for the Fed. All right, another headline. This one comes from Bloomberg. It says JPMorgan's asset manager creates venture to expand rental bet. So we read from this, JPMorgan Asset Management, along with the principals of Georgia Capital and Parent Homes, is creating a development firm called Lassiter Development Group. Lassiter will aim to build single-family rentals, with the first developments breaking ground in the suburbs of Atlanta and Nashville this year. All right, so my take on this is it's just another sign that building SFR is the new buying SFR. BTR checks a lot of boxes. Build to rent checks a lot of boxes for institutional investors, more efficient to deploy capital, more efficient to manage than traditional scattered site single-family rentals, plus lesser political risk. And of course, today's high home prices and high mortgage rates make it difficult for, especially the high home prices, make it difficult for investors to acquire homes at any scale. And I think we'll see more of this regardless of what happens in home prices and mortgage rates. It's interesting. I think that we talk a lot about, the big discount to rent versus buy right now. And I think that's a great talking point for fundraising. But honestly, this trend started back before all this happened, back when mortgage rates were cheap and homes were selling. And obviously that widening gap only helps further this demand. But I don't think this segment of the market is dependent on a more expensive homeownership market. It really serves a unique niche in the market, as I talked about with Steve Kellman of Redwood Living in a previous podcast on BTR. All right, let's keep going on headlines here. Next headline comes from LAist, Los Angeles. Eviction protections for renters who lost their jobs after the fires fails key LA City Council vote. So let me read a little bit of this. After a contentious month-long debate that pitted landlords against renters and Los Angeles City Council members against each other, a proposal that sought to grant new eviction protections to renters who lost income because of the fires failed in a crucial vote on Friday. The motion needed 8 votes to pass. Only 6 members voted in favor. All right, so after the wildfires, there were proposals for eviction moratoria and rent freezes that harken back memories to LA's years-long eviction moratoria after COVID, which of course contributed to making LA one of the most challenging markets for apartment operators. High bad debt, and property managers were talking about how those rules were really abused. Like, people did not need the benefits and just stopped paying rent. Essentially, rent became optional. And as I've shared in this podcast previously, because of all that in the aftermath, a lot of institutional groups have more or less redlined the city and county of Los Angeles for new investment. And a number of REITs have called out LA for dysfunctional politics. And Camden's CEO, Rick Campo, talked about that in our interview last week on this podcast. So then this vote happens last week. And I got to tell you, after all this talk about Los Angeles being dysfunctional, it sort of feels like an alternative universe to see LA City Council members opposing an eviction moratorium and a rent freeze due to concerns that such policies discourage new housing development and that the city and the state, not the landlord, should fund rental assistance and rental aid. So check out some of these comments from actual city council members. One said the city lacks concrete evidence of the fires leading to a surge in eviction. That said, we're nearly halfway into February at this point. We can't even look at any data to help us inform a policy decision that could have wide-ranging significant impacts. And she argued that the local and state funds should be used to provide rental assistance instead of asking the property owners to bear the burden and pay the bill. Another quote, other council members said this is reading from the article, other council members said they opposed new eviction protections because additional restrictions would discourage developers and landlords from investing in the city's housing. And a quote from council member Monica Rodriguez saying, instituting policies like this doesn't aid us in our ability to create a hospitable environment to build more housing in the city. All right, so encouraging to hear that language, and hopefully we can support those who really need but really prevent the negative consequences of ill thought out policies. All right, let's go to the other coast. And next headline takes us to Boston from NBC 10 in Boston. We have a big mayoral race, in the city of Boston. One candidate is Josh Kraft, the son of the New England Patriots owner. He put out a plan to boost housing supply and affordability and took a pretty unique approach. One I've not heard of. I've seen a lot of different plans on affordability and supply, but this one's a little bit different. So the current mayor supports rent control, but Kraft is proposing an opt-in version of rent control, where property managers who opt in to the rent control program would receive large tax benefits in return. So let me read a bit of this article. Kraft on Wednesday unveiled more details for the housing plan he floated during his campaign kickoff last week, including a voluntary form of rent control. If landlords agree to keep annual rent increases to no more than 5% plus any change in the consumer price index for a decade, they would receive a 20% property tax rebate. To be eligible, renters would need to make no more than twice the area median income. All right, so obviously to figure a lot of details out about this, including how exactly you would, and put it together and enforce it and what the rules would be, et cetera. But it's interesting to see a plan that would be fully voluntary, which means that, and also incentivized. So it's actually a funded version of rent control, which, other than, the low income housing tax credit and other programs like it, we really don't have we don't have cities that have actually funded rent control. So it's a novel concept to actually fund it instead of passing the buck and demanding property owners foot the bill. And that could obviously help Boston avoid many of the negative unintended consequences of rent control. So we'll see where this goes. All right, a couple more. This one's from Globe Street. It says, multifamily developers still lack confidence to build, but occupancy is high. And I got to say, I got a little chuckle out of this one. I don't think confidence is the issue. I've never met a developer lacking confidence. All right, so that's a headline we can laugh at and excuse, no harm, no foul. But this next one is pretty absurdly misleading. From the New York Times, some tenants could get only 1 day's eviction notice under federal bill. Legislation would end tenant protections that were first put in place during the pandemic. All right, so this headline refers to the CARES Act passed in 2020 during the pandemic. It included a 30-day notice period on evictions. So here's the thing. Is it technically right? Yes. But is it misleading? Absolutely. The article makes only scant reference to the fact that most states and a lot of cities have their own eviction notice period requirements. For example, the article says California is one state where evictions can now take place within 3 days notice. It was one of 20 states that put in that category. But what it did not note in the article is that in major cities across California, like in Los Angeles, for instance, there's already a 30-day requirement. And so how do we not mention that? Additionally and critically, the article could be read to imply people could actually be evicted in a day or two, but that's not how it works either. In a lot of places, it's just the start of a legal process that can last months or in some places more than a year. And furthermore, if you're going to write this article, you got to have the balance to talk to some of the trade groups and property managers, because if you did, you know that common best practice isn't 1 day notice. That's not even good for business, let alone, of course, it's not good for renters. So, and those are the customers. So even in a city where that might be possible, it's going to be more the exception than the rule. Now, while it's totally fair to cover this story, we got to have some context here. But as it's written, and certainly the headline, it is deeply misleading. All right, let's come back to rental housing trivia. Our question this week was, at the end of 2010, there were 12 apartment REITs with market caps greater than $1 billion. Which of the below was not one of them? And I gave you 4 choices: Archstone, BRE, Home, and Post. And I warned you this is a trick question. The answer is Archstone. Now, yes, they were a publicly traded REIT and a very large one with more than 80,000 apartment units, but they were taken private in 2007 by a group that included Lehman Brothers for $22 billion. That did not end well, given the timing. And of course, everything happened with Lehman. After the GFC in 2013, the Archstone assets were sold at discounted prices to both Equity Residential as well as Avalon Bay, to other REITs. So Archstone was a REIT, but not one in 2010. So sorry, I told you it was a trick question. By the way, there's some other names here if you're not familiar with them, or if you're just going to go back in the memory bank a little bit. BRE was bought out by Essex. It's a one-time rival in 2014. Lone Star Funds took Home Properties private in 2015, and Post Properties merged with MAA in 2016. So there you go, a little REIT history. And that'll take us into today's interview, where I'm very honored to be joined by Dan Walsh, the CEO and founder of Citymark. And we'll be talking about the shift into debt and what led Dan to really sell at an opportune time his portfolio of apartments and move instead into buying loans from banks and debt funds. So hope you enjoy this conversation with Dan. And now we enter the interview portion of today's podcast, and I am thrilled to welcome in my friend and the CEO and founder of Citymark Capital, Dan Walsh. So Dan, thanks so much for being here.
My pleasure, Jay. Thanks for having me today. I'm really excited to spend some time with you today.
So Dan, one of the reasons I want to talk with you is you have such a unique background, having spent much of your career in banking before starting Citymark Capital and moving over to the equity side. So take us back to that decision to make that jump, if you could. What spurred your shift from debt to equity, and what did you see at that point that made that move attractive?
Thank you. I really had an interesting career. I worked for banks for 20 years, but kind of a unique opportunity to build businesses inside of banks, one of which was a business very similar to Citymark Capital, where we had the opportunity to build a private equity business, providing JV equity capital to key banks clients back in the late 90s. So at the time, I was coming off the RTC days when the real estate markets were recovering in the mid 90s. Many REITs were going public, and starting to really saw the institutionalization of real estate as we know it, kind of birth of CMBS. The agencies grew dramatically. And many banks that were, I would say KeyBank uniquely was in many ways on the cutting edge of that, where I had the opportunity to help build a lot of those businesses. So early days, and also kind of coming off the RTC, that correction in the 90s, starting one's career there informed the GFC and informed today to some extent in terms of how to make decisions and how to manage risk. Fast forward to 2005, was asked to build a Key's CDO business. So got a chance to kind of dabble in the structured finance side of things, learning how bonds are created, et cetera, and taking that equity background where at the time, like many debt funds now, CDOs were used to finance transitional assets. So again, had to underwrite using more of an equity background what the equity risks look like, higher risk capital positions. And then the GFC hit. And so in 2008 was asked to run real estate capital markets nationally for KeyBank. At the time, we had about $22 billion in real estate on a $90 billion book. I was asked to build out a team to value those loans and create a trading platform to sell off about $5 billion of those loans, which is what we did. Really, out of the blue, got an opportunity to join Huntington Bank in 2010, kind of out of the real estate business, which gave me a really deep view into the rest of banking, if you will, which has been super helpful to today, where was the regional president for Huntington, had a couple thousand people, 22 lines of businesses. Really learned how the capital treatment for real estate worked at Key, and then how the rest of the bank from a consumer and borrower perspective operated. So I think Steve Jobs said, when you start a business, do what you love. When I was looking at, I was having a blast. So even the Huntington job was an opportunity to really kind of reposition the bank in the community. And so we were focused on, growing earnings significantly. So we had the opportunity there. We had a lot of success. I was, getting calls to do other things. And as I really thought about it, back to Steve Jobs' quote, I really loved the business we had built in the late 90s, providing JV equity capital on real estate deals. I loved traveling the country, looking at how deals worked, how they fit into a neighborhood, the opportunity to build, create value, improve, the asset, but also, the lives of people that live there. So the whole idea of value creation and building new apartment properties, really got me back to my roots. And so I made the unique decision to launch Citymark Capital from scratch. I was super lucky in that it really combined the experience I had with Key with the new context I'd created at Huntington, which were CEOs of large corporations, insurance companies, et cetera, that in many cases became our first investors. I couldn't have planned it. It just kind of recognizing the opportunity. And so that was really what caused me to make that switch. It was 2015. I was in my mid-40s and realized if I was going to take this entrepreneurial itch that I was able to scratch throughout my time in banking and do it on my own, that was the time to do it. So I made the leap. Again, it was just everything kind of, it did seem like at a time, I wish I'd done it in 2010 in some ways from a value creation standpoint, where the market was, but it was, to your point, still good timing. And so, I'd always been kind of on the equity side and had kind of backed into the debt side throughout my career. And I just saw, again, this need for housing was undersupplied in the U.S. I probably spent the first 6 months after having left Huntington convincing people I hadn't been fired, that I actually wanted to start this company on my own, because I had a pretty great job in Huntington and enjoyed that a lot.
Well, as it turned out, you timed the market pretty well, and you sold a lot of assets at the right time. Right before rates went up and values got hit. And I imagine that was all skill, right? Obviously, no luck there at all. No, but certainly quite a bit of skill. But in all seriousness, what spurred those dispositions when you made them?
Yeah, again, you kind of go back to my building blocks. I think one of the things of the discipline of having grown up working inside of banks is that your reputation for investing or making a loan was 100% dependent upon your ability to continue to do that. So if you were wrong, repeatedly, or really is a very high wire act where you couldn't lose money. That was just kind of the mentality. Our job at the bank was to preserve and make money for our shareholders, or in the case of the equity business, we built for our institutional investors, which were from across the globe. And so what we recognized in 21 and 22 is that with our funds, we had, with the sale of those assets, we would have achieved and did achieve the objective that our investors asked us to achieve. So, we did, at the time, what caused us to make that was a couple things. One, that we had achieved we had promised our investors. Two, the markets were obviously quite toppy at the time. Floating rate debt was down to zero. We always sensitized our loan positions. We had people coming to us with deals saying, "Well, interest rate caps are cheap, but they're at $100,000 in cost to our total cap stack, so let's skip it. Let's not buy interest rate caps." And all those were blinking red signals to me that the market had gotten pretty overheated. I don't think, I certainly didn't, and I'm sure many people didn't necessarily foresee a 500 basis point interest rate increase. But I would say, back to, you look at every 15 or so years from the RTC to the GFC to today, the market does have, kind of a flush out, and I think we're in the middle of that today. I had a chance to go on CNBC, right after SVB failed. And my prediction at the time was that I didn't think that banks were going to have the same kind of issues that they experienced in the GFC, but that there would be some areas where banks would need to de-risk. And I think that's, starting to play out. We thought it was going to happen faster, but it feels like the pressure is mounting for that.
All right, so now here we are in 2025. You return to your roots on the debt side, but through Citymark Capital instead of a bank. So can you share some of your strategy? Is it, I know you're buying loans from banks, debt funds, or what can you tell us about what you're trying to do?
Yeah, so we were lucky to have dry powder where we, the primary strategy, and this gets back to every 15 or so years, again, doing our job for our investors, is to generate target return in the mid-teens. In this case, in this market, you're able to do that with a debt instrument with more predictability than with equity. Our strategy has been to work with banks to buy loans and work with their clients to then modify the loan. So we're kind of in partnership with the bank, and in some cases with the borrower, where we're able to kind of play in that 85% LTV range, which is above where the debt funds are, where the bank values the relationship with the borrower. They'd like to keep the relationship. They can't come to terms on a modification just because the borrower isn't able to make the sufficient pay down to make it a performing loan. So the banks have been, almost coming to us as an extension of their balance sheet, where we buy the loan, we then restructure, modify the loan in a way that the borrower can handle to give them a couple of years to get to the other side of whatever we're, working through from a market perspective, and do that over and over and over again. And we've been fortunate to do a decent amount of that already. When I was, what we've really kind of built is the trading partner I wish I had in 2009 when we were selling loans off the KeyBank's balance sheet. And trying to, like, this 500 basis point increase is hitting these assets that just really kind of creates a math problem. And when you look at the underwriting, in many cases, the deals, whether they're new construction or bridge to agency, which is the two areas we're mostly focused on, they're hitting their pro formas in most cases. There might be a little bit of erosion in rent growth just because of the supply issues now. But for the most part, it's, in prior downturns, it was kind of, maybe a little bit of irrational exuberance, as Greenspan called it back in, the GFC and beyond. This, for the most part, I think that the banks are well capitalized. There wasn't crazy leverage being put on. There's a lot more discipline, but this is just a new territory where you see this kind of massive interest rate increase that hasn't happened since early 80s.
And what's the profile of the assets that you're targeting in terms of markets, asset class, vintage, and is it similar to what you target on the equity side?
Yeah, so it's been kind of an evolution. We can do anything in the capital stack from common equity down to senior debt. When Silicon Valley failed and we saw the interest rate increases occurring, we spent a lot of time working with potential partners or operators on providing preferred equity, and looked at a lot of that. Didn't do any of it in the multifamily space, just because the math still didn't work. And so what we've been able to do in what we've been able to do in like I said, is working with the banks to make that math work, where everybody kind of gives a little to make make sure we can hit our target return for our investors. It's not just banks. We are able to do this with debt funds. If you go back to, I think one of our strengths is we really know how the cost of capital works for a bank. And where the starting point is, commercial real estate can be very accretive to the net interest margin for a bank, but the capital used and the capital charges against real estate are higher than other parts of the business, whether it's auto loans or C&I loans. And so when especially regional banks load up on construction loans, which really have high spreads, they also have the biggest capital charges. So we've been focused on working with banks on helping restructure maturing construction loans to do the extension I described, modify the loans. And then also same thing on bridge to agency, where, many of those loans that were expected to go to agency, because the interest rate environment, the pay downs are too significant to get there. So in some cases where a borrower, the bank is looking for a $5 to $10 million pay down, we're able to restructure and do a $1 or $2 million pay down or even a smaller one, just to help them get to the other side. And I wanted to stress that too, because it's not meant to be loan to own. Certainly we can step in and operate an asset if we had to and bring in our partners. We have 400 different potential operating partners across the U.S. But there's a lot of friction involved with foreclosure and bankruptcy, et cetera, that you can do, and it can be, create good returns, but it also, like I said, is a big devotion, time, and energy. And if you can do, these modifications that end up performing and giving borrowers a couple of years to protect their equity and get it out, we're trying to do as much of that as possible.
Yeah. Yeah, that makes sense. But just to be clear, though, you're still looking at your construction loans. I'm guessing just generally, newer vintage, major markets. That's generally the target.
Yes, and working, in pools. We are still open to do JV equity as well. So we are still seeing, I'd say the corollary or the other dynamic that is likely to occur with, we expect, we'll talk probably a little bit about this more, as the year unfolds, these loans will either get modified or the banks are going to force sales. And I think those forced sales will result in attractive equity opportunities as well on the acquisition side. And so we're fortunate we have a partnership with PGIM to give us capital to participate significantly in wherever the market goes. And I think it's going to be a combination of both, the need for loan modification and direct asset purchase.
Dan, as you know, others on the institutional side are putting more focus on debt funds right now over equity. Is it as simple as just finding better returns on the debt side right now, just kind of going where the opportunity is? Is it as simple as that?
Yeah, there's a couple of dynamics there. I believe, again, on a relative value basis, if you look at doing a debt fund and getting a low double-digit return versus, doing equity right now and maybe getting into the mid, kind of the mid-teens, that spread is, given the current market environment, a little bit of stress and supply and demand and lack of rent growth, just on a relative value basis is better in the debt fund space, which is, we've kind of tackled it slightly differently where the return profile for taking a debt position is more in the mid to high teens. So again, on a relative value basis, it's the best place we believe one can invest. The other dynamic that we're hearing a lot in talking about the banks, and this has kind of played out over the last 30 years, is that in each of these downturns, banks have, in a calculated way, less and less market share. You have private lenders filling the space. And some banks have said, rather than use our balance sheet in the future for bridge agency or new construction, we're just going to lend to debt funds because it's a much better return on our capital. In that case, it doesn't, you depend upon the bank. And we're talking about 40 or 50 different banks right now, and they all have slightly different views on how capital charges work. So that's kind of interesting. But some of the larger ones that have a debt fund practice have said, that it gets treated more like a REIT loan, which in many cases isn't considered CRE. So the return on their capital is massively better than a one-off loan to a CRE borrower.
So let's just dive more into the distressed type for a moment. When you're buying a distressed or potentially distressed loan, you mentioned you're not necessarily wanting to take over the asset and doing that. But obviously, if it does come to that, I mean, you've got that asset management experience, right? So you have that skill set if you need it.
Yeah, yes, that's right. We do. We're able to go through that process. Whether it's running the asset, but again, it's front edge where there's a couple dynamics going on right now. Again, the reason we started working with banks first, in many cases, it's been they don't have the workout teams or the portfolio management teams to deal with this. Now they've had to ramp up, and what most banks do is they move line lenders over to work out and try to figure out how to preserve their capital. I'd say, and so some banks that are very keyed in on their cost of capital are using this opportunity to move positions that free up their capital, help them play offense. And I know, we're at NMHC that a lot of the banks said they're ready to go this year and lend more money, and they want to get higher spreads and a higher market, which also, obviously kind of messes up a little bit the ability to generate equity returns if that cost of capital is higher. But nonetheless, other banks they'll come to us and say, "Here's my biggest problem loan," and usually it's pretty hairy. And in that case, you do have to underwrite some kind of process where ideally you work with the borrower again to get the other side. But if that relationship's already highly stressed, the banks have come to us and said, "We want you to take this over." And there is some chance that it will need to be, could go through bankruptcy and foreclosure. And it goes beyond just operating the asset, where you have to understand and actually underwrite those risks, because, and that very, state to state. So in theory, it's great to say, "Hey, we're going to buy a bunch of loans from banks." In practice, it's highly, highly technical to make sure you don't end up in a position that creates a lot of risk for, your own platform.
Yeah, so I guess that's an interesting kind of distinction between what you're doing versus others, which is others may be trying to originate a new debt fund, and you're out there actually trying to buy loans, which, as you mentioned, requires much more technical skills, probably.
Yeah, exactly. It's I don't want to say originating loans is easy, but on a relative basis, and so that's why there's a differential in the return for what we're expecting between a new origination debt fund and what we're doing. And there's a huge drag for banks and debt funds who would sell us loans as well to work these things out. So there's a certain kind of pickup they get from not having people spending time and energy trying to work those things out and having to go to the street and say, quarter over quarter, here's our distressed loan situation, here are the risk ratings, and the CFOs of the bank, oftentimes the ones we are talking to, as opposed to the real estate folks that, because the CFO is on the front line, reporting out how they're, what they're doing to manage the risk in their CRE book.
Yeah. So for the CFO, it's a win to get some of these things off their book.
Exactly. Yeah. And is in a capital efficient way as possible.
Yeah, absolutely. One other question for you, Dan, is as you know very well, one of the stories in 24 was the lack of distress hitting the market, despite so many loan maturities. I mean, I feel like every week I read about the wall of maturities, particularly among construction loans and other short-term floating rate loans. Lenders turned out to be pretty patient, and a lot of other deals just got worked out behind the scenes. And I don't think anybody even knows the true numbers, on some of this stuff. So there's still a lot to work through. And so if you could put on, take a crystal ball for a moment here, how much more financing distress do you think we'll see this year?
Yeah, I think, it feels like, it depends on what source you look at, but over 24 and 25, you have anywhere, from $500 billion to $1 trillion of loan maturities, depending upon which source you're looking at. Let's say it's $500 billion. I think what happened in a lot of bank and debt fund situations is they did a short-term modification. So they pushed those, 24 maturities into 25, maybe 26. Meanwhile, you have a bunch of 25 maturities coming. So you think about the originations from 2021, 2022 with a 3-year term and 2 1-year extensions. Those maturities are all hitting right now. The debt funds, if you compare the debt funds today to the CMBS lenders of the GFC, the debt funds have a decent amount more flexibility to work with the borrowers, which has than the CMBS folks did back in during the GFC. So you hear the proverbial kick the can down the road, et cetera. But all those, I think many of those modifications were done with the expectation where everybody's looking at the rate curve showing some pretty significant rate cut relief that hasn't materialized. And now, as the curve seems to have stay high, higher for longer. I would say that's the other thing I should have mentioned earlier in our conversation when we kind of did our own math on inflation back in 23 and 24, just to look at the likelihood that it was going to get anywhere close to 2%, and we didn't see any chance of that happening in the near term. So we were kind of already in the higher for longer camp, which is why we really put our efforts into preparing this platform for working with banks and debt funds to restructure these loans. So our expectation is that with a lot of those modifications hitting, that probably starting this summer, we'll start to see a lot more activity on the loan, on the forced sale side and the loan purchase side. One other big factor is, again, back to the GFC. I mentioned this earlier. Banks are really well capitalized, so they're able to. It's just a matter of patience and how much regulatory pressure there is for them to move these loans off their books. They've been able to modify. The other piece of information we've been getting pretty regularly from banks is that. Again, with a 15-year run-up and a little bit more conservatism on the leverage level, is that the borrowers were pretty well capitalized. And so when they did the modifications in 22, 23, 24, the borrowers were, in many cases, able to write the checks that were needed to get those loans in a place where they would be performing loans. The problem, like I said, is that that was with the expectation that, now rates would be lower and those loans would be moved off the books through an agency refi or some other, way to move it off. And that's where it feels like the pressure is mounting, where those options are starting to run out. And so, we're not rooting for distress, but and that's why we structured this the way we did, is to help people, find a way to keep their asset and get a couple more years. Because I think if you look at 26 and 27, the multifamily fundamentals look very attractive. So if you can help people kind of preserve their equity and just hang in there, that's the role we'd like to play to help that happen. And I think it'll be a lot of activity in the second, third, and fourth quarters of this year.
Yeah, no, I agree. And certainly with that bullish outlook for 26, 27, you're going to have, sponsors and equity and lenders alike, trying to, probably retaining some optimism and trying to find some ways to make these things work if they can. Well, Dan, thanks so much for your time. Really enjoyed picking your brain, and thanks for sharing some of your strategy with us. And that's a wrap on episode 22 of The Rent Roll. Again, a big thanks to our sponsors, Madeira Residential and JPI. And thank you to all of you for making us part of your day. We'll see you next time.